Welcome back to Switzer. My next guest was a legendary educator for many of the country's financial planners, and I regard him as one of the best prepared retirees in Australia. So what are key lessons we all should learn from him for being ready for that time when we stop work? Peter Thornhill joins me in the studio. Peter, nice to see you, mate.
Thanks, Peter.
Okay, Pete, we've talked before, and some people might have been lucky enough to see when we did talk. What are the critical lessons you think people have to understand to be ready for retirement?
It's not about the lump of money so much as the cash flow, i.e. what level of income do you require when you retire? And then you work backwards from that to calculate what the lump sum is that you will need to generate that income.
Okay, let's throw 100,000 in, because a lot of people think 100,000 would be nice. So what kind of figures are they thinking?
Okay, rough rule of thumb, I use 5% as the generated cash
annual
flow.
Return.
Annual return.
Yeah.
In income terms.
Yeah.
So I divide 100,000, if that's the amount of income I need, I divide it by 0.05. That tells me that I need $2 million free investable assets to generate the $100,000 a year.
Okay. So we worked out the figure. What do people need to know next?
Well, it's which asset class is going to produce the goods.
Yeah.
And the hard part is that this is where people's emotions take over.
Yeah.
Good sense goes out the window, because if we were rational human beings, we would all do exactly the same thing.
Okay, now what is that exactly the same thing? And I think some people are going to be shocked at what you say.
Well, the best income stream that you can generate from any asset class comes from good quality businesses. Buy shares.
Buy shares. Not property, shares.
Don't buy property.
Okay. And you, it's interesting, I've had Chris on before you, you've done very well by not going long property.
Absolutely.
You've got one property that you retired into, but that was something that...
That was a lifestyle decision.
When most people actually accumulate, well, a lot of investors accumulate property over time.
Yes.
You've accumulated shares.
Yes.
Now, some people out there will say, that poor bugger must have suffered during the GFC. Tell us about your GFC experience.
The GFC experience, it was nerve-wracking. In fact, you'd have to be dead not to have been affected by the GFC. Watching seven figures disappear out of your asset base is not something that allows you to sleep too comfortably at night. However, the balm during that period was the cash flow from the portfolio.
Okay. And
to me, the joy of the GFC, this is going to sound really crazy, but I actually look forward to a GFC.
So you don't fear crashes, you look forward to crashes?
I love them. Okay. I love them.
So at the moment, my viewers are saying, is this guy certifiable?
Possibly.
All right, so tell us why, because let's imagine, I don't know what your figures were, but given what you said, if you had 5 million in there, you might have gone down to, give us a 50% fault, you might have gone down to...
2.5, 3 million.
Yeah. Now, that would have made a lot of people feel a bit nervous. If that was your situation, why wouldn't you have been nervous?
Because watching the share prices drop is a totally different thing to the cash flow that's coming out of the portfolio.
Right.
That is what we're living on.
Yeah.
We're not living using the capital as a source of income. It's generating the income for us. And if we go to the first slide, CBA during the GFC went from around $64 down to 26.
Yeah.
Now, before I go any further, I've got to ask the question. Does anybody believe that in the GFC, CBA lost more than half its business?
No.
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 Okay.
And one of the reasons why I was saying, well, I was a bit positive like you were, and people said, well, what would you buy? I said, well, maybe the 4 banks. That's about it. That was as confident I was going to be then, but if I was talking to you now, I might be more confident. But
yeah, well, they fell to 26. Because credit markets had locked up, companies were finding it difficult to raise capital.
Yeah.
They wanted to bolster their balance sheets, so they came back to the one source they could generally rely on, which was shareholders. So they raised fresh capital from shareholders.
Yeah.
So CBA offered us shares at $26, which we bought. Now, put that parcel to one side and let's follow its fortunes. Every dividend that Commonwealth Bank has paid since has applied to those $26 shares.
Yeah.
If you total up the dividends that CBA has paid, CBA's dividends have paid us back more than half what we paid for
$14.23.
Yeah.
Yeah, okay.
On a $26 share.
Yeah.
The last 12 months dividend, based on the $26 share price that we paid for them, leaves us currently on a yield of about 14%, not even taking into account the franking credits. It is Christmas.
Yeah. I've got to say, my argument was on a dollar cost average basis, if you happen to buy at 64 and you can buy at 26, you're pushing your share price down to $30 something. But I forgot about that dividend yield on that low price.
It is absolutely outstanding. Yeah. So the cash flow from CBA subsequently has helped boost. Dividends were not cut anywhere near as badly as share prices fell.
In fact, I think in CBA's case, they're only down for 1 year, weren't they?
1 year,
and next year they actually went past.
That's right, and they have continued growing subsequently.
Yeah.
The second one, just for example's sake, is Wesfarmers, if we have a look at that.
Yeah.
Again, Wesfarmers fell from around $40 down to, and they issued shares to shareholders at $13.50.
Remember it well.
The dividends have paid us back half what we paid for the shares, and we're currently sitting on a yield of around 14% again. So,
all right, so the lesson is becoming clear. We're talking about companies, quality companies, that pay pretty good dividends.
Yes.
But you're saying when you buy them during scary times, the yield you pick up is fantastic on good quality companies.
On good quality companies.
Yeah.
And you add the cream on top, which is that those $26 shares are now fetching $73.
Yeah.
The $13.50 Wesfarmers shares are now fetching over $40.
So how many stocks do you hold in your portfolio?
Directly, there's about 50.
So you only got 2% exposure to any one company?
Basically, in fact, it's less than that because I use listed investment companies as a core, and they hold upwards of 100 stocks in their portfolios.
Right.
So I'm diversified right across. I favour industrials, not resources, because resource companies are poor dividend payers.
And they must have been tempted when BHP got down to 30 and the yield was about 4%, grossed up to nearly 7%.
No.
No, okay, fair enough. So it's a long history of not paying resources. But I guess the question then is, what kind of average yield? How many years have you been putting all this portfolio together?
It started seriously when we got back to Australia in 1988. And I have got the entire records from 1988 in Microsoft Money. It's become an amazing library, if you like, or history. And there wasn't a hell of a lot there. I think our dividends back in 1988 were about $700 that year. Now we're talking about the mid-six figures in terms of income. And that was done through simply investing while I was working.
And what kind of percentage yield are you getting from your dividends each year before you gross it up?
It's around about 4.5% to 5%.
Yeah, and grosses up to about 6.5%,
7%.
Yeah, which is better than the 5% that you worked on.
Absolutely.
Do you maintain a buffer just in case dividends surprise on the downside?
Well, I guess the answer is yes. The buffer has been there throughout our lives.
How big is it?
It is about 2 years' income.
So about 200 grand if you're on 100,000.
If you're on 100,000, so there's 200,000.
2 years worth of income.
Worth of income sitting there.
Have you had to cut into it very, very many times?
No, because the emotional buffer is that my wife and I, when we got married, we could never bring ourselves to spend all we earned. So we've always lived within our means, and that remains the case today.
When did you learn this lesson? What was this epiphany moment in your life?
I honestly, well, I guess there was one major epiphany, but I'm not sure whether it's nature or nurture. But the real break for me was, having only been in the UK 2 or 3 years, the first oil shock in 1973. Share markets absolutely tanked. Now, I was young, foolish, didn't have any money anyway, so there was nothing I could do, but some very, very kindly English people in the industry took me to one side and gave me the most valuable education I could ever have, the most extraordinary apprenticeship. That cash flow is the key to the wealth, not the price of shares, not buying and selling or speculating in price movements. And that has sort of stuck with me, as has the habit of not spending all we earn. So we've always got the buffer there.
Right.
And that has been extremely valuable from another point of view, in that when issues like CBA or Wesfarmers come up, we've always got the dry powder.
Yeah, exactly. If people want to know more, motivational money, motivated money is a website.
Correct.
motivatedmoney.com.au.
Yep.
Pete, thanks for joining us on the program and sharing your educational insights.
My pleasure.
That's Peter Thornhill. Okay, thanks for joining us on the program. That's it for tonight. I'll see you tomorrow.